Paying taxes for your business sucks. Overpaying, on the other hand, well, that's much worse. Unfortunately, 9 out of 10 business owners overpaid their taxes regardless of whether they have an accountant or not. And in most of these cases, it comes down to avoidable tax mistakes, which is why in today's video, we'll be sharing the top 5 mistakes business owners make with taxes. We'll also show you how you can avoid them so that you can keep more money in your pocket and stay out the IRS's radar. So like, subscribe, and let's jump right in. Number 1 is using a personal account for business. The first and probably the biggest mistake a lot of business owners make is keeping their personal and business funds in one bank account. Now, if you're a sole proprietor or operate a single member LLC, it just seems easier to have all your funds in one place. But while easy now, this is going to prove costly in terms of time and money when you get down to preparing your taxes. Here's why. Without a separate business account, tracking how much income flows in and out of your business is pretty difficult. Remember, you'll need to report all your income at the end of the year, as well as calculate your expenses if you want to claim them as deductions from that income. Business deductions can and will knock off considerable money from your tax bill. Beyond taxes, you can't really tell how your business is doing financially when there's no distinction between your personal and business cash. By setting up a separate business account, you can keep your business transactions separate, which will make filing your business taxes a whole lot easier. Plus, you will know how your business is doing at all times. That said, with the LLC or S Corp, you are legally required to set up a separate business account and keep your funds separate. However, this isn't a requirement for sole proprietorships, which means it's upon you to do it. The good news is that opening a business account is easy, and you can do it at any bank in the country. Now, while a sole proprietorship isn't inherently bad, you want to consider switching to an LLC once your business has attained some form of stability and generating some revenue, as LLCs offer personal asset protection. And once you hit $40,000 in net income, you should move to an S Corp to save on self-employment taxes. 2 is not maximizing on your business deductions. If you don't know yet, starting a small business is one of the best tax strategies out there. And that's because nearly all business expenses are tax deductible. Tax deductible simply means you can subtract the expense from your adjusted gross income, otherwise known as AGI, so right before your tax rate is applied. So if you have an AGI of, let's just say $100,000, and your tax deductions amount to $30,000, then your taxable income will be $70,000. The problem is that most business owners don't really know all the tax write-offs that they are entitled to, which means they end up missing out on some of them. And that's because the IRS doesn't typically tell you what you can and can't deduct. Rather, IRS Code Section 162A defines allowable business deductions are as paid or incurred that are ordinary and necessary for carrying out any trade or business. Now the question is, what is considered ordinary and necessary here? Well, as the business owner, you get to decide this as based on your business. Some expenses are tax deductible regardless of the type of business. For instance, business miles, utilities, and travel are all tax deductible. Also, if you use your personal car or section off a home for business purposes, you can claim partial tax deductions on your tax returns for these. However, what is ordinary and necessary for one business might not be for another. For example, a catering business will not have the same expenses as a construction business. So make sure you understand all the tax deductions you're entitled to and start keeping records to track them so that you're able to deduct them during tax season. The goal here is to write off as many business expenses as possible. If you do this, you'll be surprised by just how much you've been losing in tax savings every year. Have you ever considered why I'm paying so much in taxes? I hear business owners ask me all the time, Jonathan, how can I lower my taxes and pay the least amount of taxes possible? Or how can I scale my business past 6 figures? Right now, for a limited time, I'm offering a free tax strategy session where I'll be going through your 2 years of your past tax returns to see if you're overpaying in taxes and give you some free tax strategies to use to lower your taxes by 30%. Also, I'll throw in my free ebook on the top 10 tax deductions for real estate investors and small business owners, along with your tax strategy. Click the link below to schedule your free tax strategy session now. Let's get back to the video. Number 3 is missing out on tax credits. In many cases, business owners place a lot of the emphasis on tax deductions and little, if any, on tax credits. In fact, many businesses are not aware that they are eligible for certain tax credits. Interestingly, tax credits can end up saving you a lot more taxes than deductions depending on the nature of your business, and that's because tax credits reduce your tax bill dollar for dollar. That's right, unlike a deduction, which comes off of your AGI, adjusted gross income, you subtract a tax credit from your final tax bill. So if you owe, for instance, the government $15,000 in taxes, but qualify for a tax credit of $3,000, then you only have to pay $12,000. The best part is that you don't use up all your tax credits for the year. You can carry them over for future years. Some common business tax credits include work opportunity tax credit, small employer health insurance premiums credit, employer credit for paid family and medical leave, disabled access credit, new market credits, low income housing tax credits, and employer provided child care facilities and services. Now, if you want to claim multiple credits, you will need to fill out your individual forms for each credit and then report the total amount, including any credits that you have carried over from previous years, as your general business credit on Form 3800. Remember, if you want to maximize your tax savings, deductions and credits are your best bet. Number 4 is not making tax payments quarterly. If you recently transitioned from being employed to owning a business or are doing business on the side while still maintaining your job, you probably don't know how often you need to pay your business taxes. And so you may assume that you're only required to do so when you file your taxes at the end of the tax year. However, this is a big mistake that many new business owners make, and it could lead to paying hefty penalties, something you definitely don't want on your record. In reality, while all income earning Americans file their tax returns once a year, they are legally required to pay taxes as they earn income throughout the year. If you're employed, you don't have to worry about this, as your employer withholds a part of your income to go towards these tax payments. This is why most employees owe little to no taxes when it's time to file their tax returns. But what happens when you work for yourself? If you're not on a traditional wage, in other words, you own a business or an independent contractor or work as a freelancer, and you expect to owe $1,000 or more in taxes this year, you're required to pay what's known as estimated tax payments every 3 months on any qualifying income. So how do you know your estimated tax payment? The IRS provides a form known as Form 1040-ES that should help you calculate what you should ideally pay quarterly, or if you like, every 3 months. But there's an easier method, so simply calculate 110% of your previous year's taxes, then break that down into 4 equal portions to figure out what you should pay at the end of each quarter. So if you owed $1,000 last year, you should aim to pay at least $1,100 in estimated tax payments this year. Divide that by 4 quarters and you will get $275 for each quarter. Number 5 is reporting rounded figures. It is tempting to write off $495 in office supplies as $500, $785 in travel as $800, but while rounding off does make the math easier, these clean round numbers will draw unwanted attention to your tax returns. Keep in mind that the IRS has your income information from other sources too, which means that they have cross-checked most of what you reported on your return. Alternatively, they can decide to audit you because of this. So if you don't want the IRS knocking at your door, ensure you're reporting highly accurate income and expense figures on your tax returns, and avoid using estimates, especially if you don't have documentation to back them up, at all costs. Which takes us back to our very first mistake, not separating your business and personal bank accounts. When you keep business funds and transactions separate, it becomes easier to track income and expenses and therefore report accurately. Now over to you. Which tax mistakes have you been making as a business owner? Let us know in the comment section, and if you enjoyed this video, like, subscribe, and share it to empower other business owners like yourself. As always, thanks for watching, and to learn more about your taxes, check out this next video.